Inflation hit the world from 2021 to 2023, spreading fear and uncertainty everywhere. In the United States, prices rose at the fastest pace in 4 decades, peaking at 9.1% in June 2022. In the United Kingdom, grocery bills climbed 19% in a single year. In Germany, a country with a deep cultural memory of the hyperinflation that destroyed the Weimar Republic, prices rose at a 70-year high of 8.7%. Across the developing world, the situation was even grimmer. Politicians offered explanations. Supply chains, they said, the pandemic, the war in Ukraine, and to be fair, all of those things were true, but they told only part of the story, and arguably the less interesting part. Because while hundreds of millions of ordinary people were cutting grocery lists, skipping doctor's appointments, and quietly draining savings accounts that had taken years to build, something else was happening at the other end of the economy. Corporate profits were hitting all-time highs. Billionaire wealth was compounding, landlords were raising rents, banks were booking record interest income, inflation hit the world from 2021 to 2023, spreading fear and uncertainty everywhere. In the United States, prices rose at the fastest pace in 4 decades, peaking at 9.1% in June 2022. In the United Kingdom, grocery bills climbed 19% in a single year. In Germany, a country with a deep cultural memory of the hyperinflation that destroyed the Weimar Republic, prices rose at a 70-year high of 8.7%. Across the developing world, the situation was even grimmer. Politicians offered explanations. Supply chains, they said, the pandemic, the war in Ukraine, and to be fair, all of those things were true, but they told only part of the story, and arguably the less interesting part. Because while hundreds of millions of ordinary people were cutting grocery lists, skipping doctor's appointments, and quietly draining savings accounts that had taken years to build, something else was happening at the other end of the economy. Corporate profits were hitting all-time highs. Billionaire wealth was compounding, landlords were raising rents, banks were booking record interest income, and governments, buried in debt, were watching that debt quietly shrink in real terms, paid back in currency worth less than when they borrowed it. Inflation, it turns out, is not just a tax, it is a transfer. The question economists rarely ask loudly enough, and that almost no politician dares to answer honestly, is a transfer from whom to whom? This is that story. Part 1. The illusion of a shared burden. Most people understand inflation the way they understand rain, something that falls equally on everyone. You go to the supermarket, prices are higher, you pay more. The end. But this intuition is dangerously wrong. Think of it this way. Imagine 2 neighbors living side by side on the same street. One is a retired school teacher who spent decades saving cash in a savings account. The other is a real estate developer who owns 10 apartment buildings and carries $20 million in fixed-rate mortgage debt. When inflation hits 8%, the school teacher's savings lose 8% of their purchasing power every single year. Silently, automatically, with no one to sue and no one to blame. Meanwhile, the developer's $20 million debt is also losing 8% of its real value every year. Except that loss falls not on him, but on his lender. The developer is, in effect, being paid to borrow. This is not a hypothetical. This is the fundamental arithmetic of inflation. And it's the key to understanding who is really on the winning side. The Federal Reserve Bank of St. Louis put it plainly in a 2022 analysis. borrowers directly benefit from unexpected inflation because they can pay back their loans in depreciated money. In the same way, lenders lose out. The same analysis estimated that the purchasing power of US savings deposits, essentially loans that ordinary people make to banks, fell by nearly $1.8 trillion in the 12 months ending March 2022. $1.8 trillion, quietly, invisibly, with no press conference and no government apology. Part 2. The Corporate Playbook, Greedflation, and the Art of the Excuse. In the summer of 2021, something unusual began appearing in the transcripts of corporate earnings calls. Documents published every quarter in which company executives address shareholders and investors. Executives at some of the world's largest consumer companies were, in plain language, telling investors that they were raising prices beyond their actual cost increases and that they intended to keep doing so. Procter & Gamble, Kimberly-Clark, General Mills, PepsiCo, the makers of products that sit in almost every household pantry and bathroom cabinet, were openly discussing what one analyst called the art of pricing. Researchers at the Groundwork Collaborative went through these transcripts. What they found was striking. Kimberly-Clark executives boasted that pricing has continued to be a big driver behind our top-line growth. Ulta Beauty executives touted benefiting from an elevated level of price increases. PepsiCo's chairman said the company might have to take additional pricing. Corporate jargon for, "We're raising prices again, and our shareholders will thank us." And the numbers bore them out. PepsiCo's net income rose 16.9% to nearly $9 billion in 2022. General Mills saw net income climb 16.5% to $2.7 billion. Ulta Beauty's profits jumped 26% to $1.2 billion. Meanwhile, at the checkout counter, the shopper was blaming supply chains. The question is, were corporations causing inflation or just exploiting a chaotic moment to do what they had always wanted to do? The answer, according to the most credible research, is both. And the distinction matters less than the outcome. The Federal Reserve Bank of Kansas City published a study finding that growth in corporate markups accounted for more than half of consumer price inflation in 2021, a contribution it described as substantially higher than during the preceding decade. The Economic Policy Institute, analyzing data from the Bureau of Economic Analysis, found that rising profit margins explained well over 40% of the rise in the price level between the end of 2019 and mid-2022, compared to the historical norm of profits explaining about 11 to 12% of price changes. By 2023, the picture was even clearer. The Groundwork Collaborative found that corporate profits drove 53% of inflation during the second and third quarters of 2023, even after supply chains had largely normalized and wholesale costs had actually begun falling. The Institute for Public Policy Research and Commonwealth, in what was described as the largest review of its kind, examined 1,300 companies across 4 continents and concluded that profiteering by a relatively small set of companies had pushed consumer prices significantly higher than supply chain shocks alone would have warranted. The Federal Reserve Bank of San Francisco offered a more cautious view, arguing that markups across the entire economy had remained essentially flat, and that greedflation was not a primary driver. And to be fair, their restraint is worth acknowledging. Inflation is a complex beast with many fathers. COVID-era fiscal stimulus, supply shocks, energy price spikes from the Ukraine war, and a decade of ultra-low interest rates creating excess liquidity. All of these played real roles. But here is the critical point that gets buried. Whatever caused the initial inflation, many large corporations chose not to reverse their price hikes when costs came down. They could have, they didn't. As the EPY noted, profit margins still have not started moving meaningfully closer to pre-pandemic norms, even into 2024, long after supply chains had healed. The inflation became an alibi, and many companies used it as one. This is what economists call a ratchet effect. Prices go up for a real reason. They don't come down when the reason disappears. The gap between wholesale costs and retail prices. The space in which profit lives quietly widens, and the consumer, accustomed to the higher price, stops noticing. Consider this analogy. Imagine a taxi driver who raises fares because of a gasoline shortage, then keeps the higher fares after the shortage ends, explaining that costs remain elevated. The customer, who doesn't have access to the driver's fuel receipts, has no way to know they're being charged 2021 emergency prices in 2023. The driver doesn't lie, he just doesn't volunteer the truth. Multiply this across 10,000 industries and you have a modern economy. Part 3. The Landlord's Market. How real assets become fortresses. If corporations are the most visible winners of inflation, asset owners are perhaps the most quietly triumphant. Here is a principle that every wealthy investor learns, but that most economic textbooks bury in footnotes. In an inflationary environment, things hold their value. Money does not. This means that anyone who owns real estate, commodities, infrastructure, or equities, in other words, anyone with significant wealth, has a natural buffer against inflation. Their assets reprice upward, their fixed-rate debt shrinks in real terms, and their tenants, unable to afford to buy the assets themselves, fund the entire arrangement through rental payments that also rise with inflation. The math is almost elegant in its brutality. Take a landlord who owns apartment buildings purchased in 2018 with 30-year fixed-rate mortgages at 4% interest. When inflation hits 8% in 2022, three things happen simultaneously. First, the nominal value of the apartment rises. Real estate is a tangible asset, and its price tends to track inflation over time. Second, the real value of the mortgage debt falls. The landlord is now repaying with dollars that are worth less than the dollars borrowed. Third, rents rise since tenants need housing and the landlord can reprice at each lease renewal. The landlord's lender, typically a bank or a pension fund representing savers, watches the real value of the loan they issued erode year by year. The tenant, who earns wages that rarely keep pace with rent inflation, falls further and further behind. And the landlord, who did nothing except own something at the right moment, profits from all sides. This is not a morality tale. It is a structural reality, and it shapes the world. Knight Frank's 2023 Wealth Report found that real estate was considered the top opportunity for high-net-worth investors during the inflationary period, with private U.S. investors deploying more than $302 billion into commercial real estate in 2022 alone. As Citi Global Wealth Management's Chief Investment Officer put it, real estate and alternatives are where wealth will be grown over the coming decade. Researchers at the National Bureau of Economic Research, analyzing 8 major asset classes over more than 5 decades, confirmed the structural advantage: real assets. Real estate, commodities, and infrastructure provide meaningful protection against energy inflation and outperform during periods of unexpected price increases. Stocks and bonds, in contrast, show negative returns when core inflation rises unexpectedly. This creates a profound bifurcation: those who own things, land, buildings, commodities, productive businesses, ride inflation like a wave, those who own money. Cash, savings deposits, fixed income bonds are drowned by it. And here is the cruelest irony: the people most likely to own only money are the poorest. The people most likely to own a diversified portfolio of real assets are the wealthiest. Inflation, structurally, moves money from the bottom of society toward the top. A 2023 study by Oxfam found that just 95 corporations made $306 billion in windfall profits. In 2022, overall, profits of food and energy corporations increased by 256%. Of those windfall profits, 84% was paid to wealthy shareholders in the form of dividends and buybacks. On the other side of the ledger, as the UK's Institute for Public Policy Research documented, corporate profits surged while wages failed to keep pace, resulting in the working class experiencing the largest decline in disposable income since World War II. Part 4. The Debtor's Secret. Why governments love inflation, even if they'd never admit it. There is a beneficiary of inflation so large, so obvious, and so little discussed in polite company that its absence from public debate amounts to a kind of collective amnesia: sovereign governments. By 2022, the US national debt exceeded $30 trillion. The UK, Japan, France, Italy. Every major economy was carrying debt loads that would have been unthinkable a generation ago. These debts, for the most part, are denominated in the national currency and carry fixed nominal interest rates. When inflation rises, the real value of that debt falls. A government that borrowed $1 trillion at 2% interest and then presides over 8% inflation is, in effect, paying back that debt in money worth 6% less per year than when it was borrowed. The bondholder. Often a pension fund, a foreign government, or a domestic saver, absorbs the loss. The government keeps the benefit. The St. Louis Fed again is admirably blunt on this point. One of the biggest borrowers in the economy is the government. Inflation is going to reduce the real value of this debt at the expense of the bondholders. Since government debt is backed by current and future tax revenue, the reduction of government debt is going to benefit the current and future taxpayer. This is, in essence, a hidden tax on savers, one that never appears in any budget, never requires a vote in any legislature, and never has to be explained to any constituent. It is inflation doing the government's fiscal dirty work silently in the night, while the finance minister talks about fiscal responsibility in the day. This is not a conspiracy theory. Economists have known about it for decades, and some even argue it is occasionally necessary. That moderate inflation is one of the few politically viable tools for reducing unsustainable debt loads without triggering formal default or austerity-driven social collapse. John Maynard Keynes understood it. Milton Friedman documented it. But knowing about it and telling people about it are very different things. There is a historical precedent worth examining. After World War II, the United States carried debt to GDP ratios exceeding 100%. Rather than raising taxes dramatically or cutting spending catastrophically, the US government relied heavily on a combination of growth and moderate inflation to erode the real value of that debt over the following 2 decades. The savings accounts and war bonds held by ordinary Americans quietly funded the solution. Most Americans never understood what was happening. Most don't today either. Part 5. The Bank's Quiet Windfall. No account of inflation's winners would be complete without addressing the financial sector. And the picture here is more complicated and more interesting than it first appears. When inflation rises, central banks raise interest rates to fight it. This is the conventional playbook, and it has costs and benefits distributed very unevenly. On one hand, rising rates hurt borrowers, homebuyers, small businesses, and anyone with variable rate debt faces higher costs immediately. This is the part that receives breathless news coverage. On the other hand, rising rates are a direct gift to banks' core income engine. Banks borrow money cheaply, largely through customer deposits, which they pay very little for and lend it out at much higher rates. The difference between these two numbers is called the net interest margin, NIM, and it is the heartbeat of banking profitability. The Federal Reserve Bank of Kansas City confirmed what the data makes obvious. Most banks became more profitable as the Federal Reserve raised rates in 2022 to 23. The mechanism is particularly advantageous because banks are not obligated to pass rate increases along to depositors immediately or fully. They raise lending rates quickly. Commercial loans, mortgages, credit cards, while deposit rates crawl upward slowly, if at all. The gap between what they charge and what they pay widens, and profits flow through that gap. Between 2021 and 2023, the net interest margin for US banks rose sharply from its pandemic-era lows. The Office of the Comptroller of the Currency noted that higher inflation would be positive for most banks' profits, as elevated liquid assets would reprice upward faster than liabilities. The FDIC reported that U.S. banking institutions collectively earned $256.9 billion in net income in 2023, well above pre-pandemic averages despite some quarterly volatility. A study of 103 EU banks from the European Banking Authority similarly found that higher interest rates increased bank profits, primarily through larger net interest income. But here is the detail that rarely appears in the financial press. While the Fed was raising rates to fight inflation and protect the purchasing power of ordinary savers, the banks that were supposed to pass those higher rates along to savings accounts were doing so with extraordinary slowness. A customer with a savings account might have been earning 0.5% interest, while the Fed funds rate sat at 5%. The bank was effectively pocketing the difference, charging the market rate to borrowers while quietly shortchanging savers. The Federal Reserve calls this deposit rate pass-through, and in the 2022 to 23 cycle, they found it was more muted than in previous tightening cycles. Translated from central bank language, banks raised what they charged much faster than they raised what they paid. There is an analogy in the energy markets. When oil prices rise, gas stations raise pump prices within hours. Sometimes within the same day. When oil prices fall, those same prices take weeks, sometimes months, to come down. Economists call this rockets and feathers. Banking institutions behave similarly with interest rates during inflationary periods. Rates rocket up on the lending side and drift down like feathers on the deposit side. Part 6. Who bears the cost? By now, a pattern has emerged. Corporations with pricing power win, asset owners win, governments win, banks win. So who loses? The answer is not elegant, but it is clear. Fixed income workers and pensioners lose. A person earning a salary that rises 3% per year while inflation runs at 8% is, in economic terms, taking a 5% pay cut. They do not feel it as a pay cut because the number on their paycheck is larger. But the number of things that paycheck can buy is smaller. This phenomenon, known as the money illusion, is one of inflation's most effective concealed cruelties. Workers who do not have strong unions, collective bargaining power, or indexed employment contracts bear the full brunt. Cash savers lose. A person who did everything right by conventional financial wisdom, worked hard, spent less than they earned, put money aside, is punished directly. Their savings sitting in a bank account lose purchasing power every single year. That inflation exceeds the interest rate they're receiving. Between March 2021 and March 2022 alone, the real value of US demand deposits, time deposits and savings accounts fell by an estimated $1.8 trillion in purchasing power. People in the developing world lose the most. Inflation in food and energy prices hits hardest those who spend the largest share of their income on food and energy, which is to say the poor. Oxfam's 2023 Davos report documented this with harrowing clarity. When fuel prices double in a Western country, it is an inconvenience. When they double in a country where cooking fuel and transport represent 40% of household income, it is a crisis. A taxi driver named Yusuf in India told Oxfam researchers, "Gas cylinders used to cost 450 rupees, but now they cost slightly more than 1,000. Now we have to choose between feeding our children or educating them." Young renters lose. Perhaps the most structurally disadvantaged group in the modern inflationary era is the young person who does not yet own property. They pay rising rents that enrich landlords. They cannot afford to buy into the real estate market that would otherwise protect them from inflation. Their wages lag behind price increases, and they watch the asset-owning generation. Their parents and grandparents, in many cases, grow wealthier in real terms simply by virtue of having bought property decades ago. Part 7. The redistribution nobody voted for. There is a phrase that Nobel Prize-winning economist Milton Friedman used that has lost none of its relevance. Inflation is taxation without legislation. It is worth sitting with that formulation. In a democracy, a tax requires a vote. It requires debate. It requires politicians to stand up and explain in public why they are taking money from citizens. Inflation does the same economic work, transferring purchasing power from some groups to others, but with none of the accountability. Nobody campaigns on a platform of, "I will erode the savings of retirees to reduce the real value of government debt." And yet, that is precisely what happens. The redistribution that inflation produces is, moreover, regressive in a specific and damaging way. It tends to take from those who have less bargaining power. Workers without unions, savers without diversified portfolios, renters without property, and transfer to those with more. Corporations with pricing power, asset owners with real estate and commodities, governments with debt, and banks with rate-setting discretion. The St. Louis Fed's analysis describes it as wealth redistribution from richer, older households that are creditors to younger, middle-class households with fixed mortgage debt, which sounds almost progressive until you realize that the redistribution from the very poor, who have no fixed-rate mortgage and no real assets, goes entirely unremarked. The very poor have no debt that inflates away, no assets that rise in value, and no pricing power. They simply pay more. Part 8. The question of accountability. So what should be done, and is it possible to do anything at all? Several governments attempted targeted interventions during the 2021 to 2023 inflation surge with mixed results. The UK, France, Spain, and several other European countries introduced windfall profit taxes. Levies specifically targeting energy companies whose profits had swelled from price spikes they had not created and could not claim credit for. The response from the industry was indignation. One major oil company launched a legal challenge to the EU windfall tax. In the United States, political leaders, including President Biden, called out greedflation directly, demanding that companies with record profits pass savings along to consumers. The Federal Trade Commission opened investigations into alleged price fixing in several sectors. None of it produced a dramatic reversal of the profit picture. More structurally, economists have argued for several tools. Stronger antitrust enforcement to reduce the market concentration that gives corporations price-setting power, indexed wages and pensions that adjust automatically with inflation, tax treatment of inflation-linked capital gains that recognizes that much of the gain in an inflationary period is illusory. A homeowner who bought a house for $300,000 and sells it for $450,000 after a decade of 4% inflation has not made $150,000. They have barely kept pace with the general price level, and financial literacy campaigns that help ordinary people understand the real mechanics of wealth erosion before they have lost another decade of savings. There is also a harder conversation to be had about the structural design of the economy itself. An economy in which large corporations have sufficient market power to raise prices above cost increases during a crisis is an economy with inadequate competition policy. An economy in which the largest beneficiaries of debt erosion include both governments and the wealthy. The two groups most capable of influencing policy. Is an economy with structural incentives against fighting inflation too quickly or too aggressively. This is not a conspiracy. No boardroom of executives sat down and decided to engineer an inflationary transfer of wealth. But incentives do not require conspiracies. They simply require that each actor behave rationally in their own interest, and that the rules of the game, shaped over decades by politics, lobbying, and ideology, systematically favor some interests over others. Conclusion: the scoreboard nobody shows you. Let us return to the scoreboard. When inflation hit, corporations with pricing power raised prices above cost increases and booked record profits. Large shareholders received 84 cents of every dollar of windfall gains in the form of dividends and buybacks. Real estate owners watched their debts shrink in real value while their rents and asset prices rose. Governments saw their towering debt loads quietly eroded. Banks widened the gap between what they charged borrowers and what they paid savers. On the other side, a retired school teacher's savings account lost $18,800 in purchasing power on every $200,000 saved. A young renter saw rent increases that outpaced wage growth for 3 consecutive years. A grocery shopper in India had to choose between food and education. A pensioner in the UK found that her fixed income, indexed to nothing, bought 15% less than it had 2 years earlier. These are not separate stories. They are the same story, told from different ends. Understanding who profits from inflation is not an exercise in blame. It is an exercise in clarity. The kind of clarity that is necessary before any meaningful reform is possible. Inflation is not a natural disaster that strikes without warning. It is an economic event with winners and losers, shaped by policy choices, corporate decisions, and structural incentives that have been built up over decades. The next time prices rise and a politician says, "We're all in this together," it is worth asking a simple question. Are we, though? The evidence suggests not, and knowing that is the first step toward changing it.